in our continuing series on trader behaviors that are beneficial to your success. Today we're going to talk a little bit about risk and uncertainty and having respect for those items, and they are different. And then I'd like to talk a little bit about how to develop a decent risk money management practice. And so let's get into how there is risk and uncertainty and how they are different. Risk is really how much are you willing to possibly risk on a trade. That's pretty cut and dry. You can say, hey, I want to risk $1,000, and then when it gets there, I'm out. The uncertainty is maybe markets are closed and you can't get out at your stop, and when we open, the uncertainty is that you're well below your risk that you had designated. So that uncertainty then becomes much more substantial, especially if you're trading things that are closed like stocks. And then the futures offer an advantage, except for on weekends, in that except for 15 minutes a day, when you're talking about the financials, you're able to actually define that risk and play within it, even though there may be additional uncertainty in the market. So I think what some people try to do is they try to define that uncertainty, and it's really a fool's game, because you really can't. There's no way telling when a bomb might go off in the World Trade Center, as it did, or when the planes flew in. There's just no way of telling these things. So when the markets continue to be more uncertain and go the way that the uncertainty drives, you got to respect that uncertainty and probably move on. So understanding the difference between the two and not taking more risk because of the uncertainty is really key to understand. So embrace the risk, understand where it is, where you're right and wrong on a trade, and respect the uncertainty that is always present in the markets. This way you'll come to find that what comes next and making the best educated guesses are just that. Successful traders are not gamblers. Rather, they're playing at a game that they feel that they have a discernible edge. So without an edge, you shouldn't trade, and without the edge, you are gambling. So if you can't find your edge and you can't define the risk and also allow the uncertainty to exist in your world, you're probably not going to have favorable outcomes. So one of the things that you want to focus on, again, is developing perspectives to your strategies. Don't play around the FOMC if you know that the Fed may raise or risk interest rates, which is pretty much every time. So 8 times a year, I tend to take off those days. Don't play, if you're a day trader, in the oil market on Wednesdays right into the inventory number at 10:30 Eastern. Plan for trades that don't have expected information coming on, and then when the uncertainty comes, play around the risk that you have set for yourself, and don't let it get out of control when uncertainty hits markets, which it always will. The next thing is developing a risk and money management practice. So this is a business. Trading is a business, and we really focus on teaching this. And one of the things that we hope to achieve is really figuring out what is a comfortable risk level for you, and it has to be individualized. So I may have been at this game longer and willing to maybe be in a sized position that you would not be comfortable in, even if we had equal dollars. Therefore, you really have to be honest with yourself and know what kind of individual you are when you get into this business. If you get into it undercapitalized and without sufficient liquidity, you will fail. You have to have the money behind you to be able to position yourself to success, which means if you can only trade one item, then trade one item. Don't worry about trading 17 different things. You're not a portfolio manager as a trader anyway. So really focus on surviving, defining that risk as part of that money management plan, but also realize that if you're here tomorrow, there's an opportunity possibly tomorrow. And you should really follow those principles that good fortune can never really be structured or predicted. However, the planning and the discipline that comes with running a business requires careful and tight management of your costs. So don't go out and get the fancy desk in the corner office, until you're making money consistently. Then you can treat yourself. But from the start, you should run any business like you are, bootstrapping it, and don't go into debt. Don't finance your trading with a credit card. There's a no, no, no. So successful traders devote a lot of time to this subject. These are big issues: managing the risk and having a plan and how you're going to do that. Do you stop yourself? Money management. If you get to a certain level in a month, do you stop? Is it a quarter? Is it a week? Daily. You should really have those numbers kind of in your head. If I lose this much money, I'm going to be done for the day. So I really believe that. Also, sometimes, give yourself a break. If you had a really great morning, there's no sense in trading the rest of the day. Take the rest of the day off and give yourself a break. So, having the right plan, defining the risk, understanding how, having the right capitalization helps, and then having a well-developed, structured approach to your trading that will then encourage successful results is all part of the business. So this is all part of the money management business. And having a good mentor to help you with this and to help you define what might work for you through proper questioning and how you come to that may be a little confusing. So we talk about that in greater depth, and if you're interested, please give us a ring. We'd love to talk to you about it. In the final video, we're going to be talking about traits number 9 and 10. Successful traders focus on making money, but they don't worry about being right. That's number 9. And then achieving balance. How do you balance life and perspective with trading and not making it consume you and your overall life tendencies.